The gold market between 2008 and 2026 has been defined by three distinct super cycles, driven by global crises, shifts in monetary policy, and an unprecedented return to hard assets by central banks. I. Historical performance, key rises and drops. Period. Trend. Price action, approximately. Key drivers 2008 to 2011. Major rise $700 right pointing arrow 1920. Global financial crisis, GFC, flight TO safety, introduction OF quantitative easing, QE, BY the Fed, 2013-2015. Major drop 1700 right pointing arrow $1050. The taper tantrum, economic recovery signals, a stronger USD, and fears of the Fed ending stimulus. 2016 to 2019. Consolidation $1,100 right pointing arrow $1,500. U.S.-China trade wars and a slow shift toward lower interest rates. 2020-2021. Pandemic spike $1,500 right pointing arrow $2,075 COVID-19. Global lockdowns, massive stimulus checks, and negative real interest rates. 2022-2023. Volatility $1,650 left to right arrow $2,000. Rate hikes versus war. Aggressive Fed hiking, bearish, versus Russia-Ukraine war, bullish. 2024-2025. Historic bull run $2,100 right pointing arrow $3,800 plus. Sovereign debt and tariffs, U.S.-China trade tensions, debt hitting $40 trillion plus, and central bank de-dollarization. 2026, projected, structural plateau $4,000 right pointing arrow $5,000. The doom loop, or consolidation. Analysts expect a new floor to form above $4,000. 2. Primary causes of fluctuations. 1. The safe haven effect, 2008, 2020, 2024. Gold is the ultimate insurance policy. In 2008, it was a hedge against bank failures. In 2024-2025, the drivers shifted to geopolitical uncertainty, tariffs and trade wars, and sovereign debt fears. As the U.S. national debt surpassed $41 trillion in 2025, investors moved to gold as a hedge against potential currency debasement. 2. Real interest rates, the inverse correlation. Historically, gold has an inverse relationship with real interest rates, the interest rate minus inflation. Why it drops? When the Fed raises rates, like in 2013 or 2022, paper assets like bonds provide a yield that gold doesn't, making gold less attractive. Why it rises? In 2024-2025, even with relatively high nominal rates, gold surged because investors bet on an easing cycle, rate cuts, and feared that inflation would remain sticky. 3. Central bank buying, the new whales. A massive structural shift occurred post-2022. Following the freezing of Russia's dollar reserves, central banks, China, India, Turkey, Poland, began buying gold at record levels to diversify away from the USD. By 2025, gold surpassed U.S. Treasuries as a percentage of global reserves for the first time since 1996. 3. Investor insights. The floor has moved. In 2015, $1,000 was the floor. Experts now suggest that the structural demand from central banks has moved the new floor to roughly $3,000 to $3,500. Watch the debt, not just the Fed. While the Federal Reserve's interest rate decisions still matter, the fiscal deficit is becoming a more powerful long-term driver. If the U.S. government continues to run multi-trillion-dollar deficits, gold acts as a hedge against the long-term erosion of the dollar's purchasing power. Opportunity versus risk in 2026. Bullish case. If global trade wars escalate into a doom loop, recession plus high inflation, gold could test $5,000. Bearish case. If the U.S. achieves a soft landing, and inflation cools significantly without a recession, gold may see a technical correction, a drop of 10 to 15%, as investors rotate back into high-growth stocks.